A fresh reading on inflation today is pushing markets higher this morning. On a headline basis, the July Personal Consumption Expenditures Index, or PCE as you know in your hood, came in line with economists' expectations, both on a month-over-month and an annualized basis. On a core basis, stripping out volatile food and energy prices, the monthly reading was as expected, while the annual reading came in just below expectations. And so for more on what this data means for you and your money, we've got Thomas Martin, who's the portfolio manager over at Globalt Investments. Great to have you here with us today. First and foremost, as you looked through all of the readings that we got on the consumer over the course of this week, backward looking as they may be, what does this set up for portfolios out there who are trying to navigate what this economic data means for the Fed's policy pathway?
Yeah, great. Well, thanks for having me on your program. I think the most important thing is that between now and year end, the consumer still seems to be fairly strong. Inflation is under control. And what we're seeing in the marketplace is this question about rotation and leadership and strength. And we're seeing more broad-based strength across the economic sectors, ones that are not just technology and communication services and consumer discretionary, but broadening out into the portfolio. So being more diversified and having more exposure to more names is probably the way to be positioned going into the last quarter of the year.
Thomas, when we think about where investors have switched their focus towards, it seems like we've had a lot of economists, a lot of strategists come on our air and talk about the employment situation and where they're kind of shifting their focus there. What is the core metric, the key data point that investors who are keeping an eye on the employment situation could be and should be monitoring closely as it pertains to what the Fed is going to do on a go-forward basis?
Yeah, we look at claims for the most part, and then, of course, the unemployment number, and then actually the employment number, so how many jobs are being created. And although we got an uptick in the unemployment rate to 4.3%, and we were in the high threes, actually mid threes for a while there, that number seemed to be a bit of an anomaly based on one-off types of items. And so next week, when we get the employment number, we're looking for jobs created to kind of bounce back up into the low 200s area where it had been, it sunk down to 100 plus last time around. And then the unemployment rate to tick back down to 4.2%. That would indicate that the economy is strong. And although employment is weakening, it's not weakening to the point where it's going to hockey stick the way it has in a lot of other past ways to recession.
We've heard a little bit of Fed speak over the course of this week. One of the most notable names, Raphael Bostic, and particularly here as we're kind of squaring away and about to begin September, what is your focus from what you need to hear from the Fed at their next meeting?
Right. So what we expect to hear is that they are going to lower rates by 1/4 percentage point. And then the question is, what is their sort of leaning and how are they going to guide us to think about the path going forward? One of the quotes from one of the governors was that we do a rate cut and then we see what happens. And so that will be more of a data-dependent kind of thing, more like what the ECB did, where they had a rate cut, but they're not sure when the next one is going to be. And that remains a matter of discussion. And not that the U.S. is going to be following the ECB, but that makes sense as you get the cycle started and then you wait and see what happens. And that may be calming to markets unless they have been really expecting this more aggressive rate cutting path, which is what's priced in right now, but it's hard to say how much they're married to that forecast.
Thomas, I want to switch gears here just slightly here as rate cutting cycle or rate cut periods in the past have been beneficial to the technology sector. There's been kind of one poster child for technology, and it's NVIDIA as of right now. What is your kind of calculus that you're running around NVIDIA post earnings, post pullback that we've seen, and now the attempted kind of stabilization for the business going forward? Not for the business, but given the outlook that perhaps isn't as strong as some on the street were hoping for.
Right. Well, it's important to keep in mind that NVIDIA's earnings and sales and margins have been expanding, but by huge amounts. And people look at the return of the stock, up 150%, and say, well, that's a lot. Maybe that's too far too fast. But given what they've done fundamentally in terms of their revenues and earnings and margins and what they have potentially in front of them, it's really not that unexpected. And the PE multiple at 30 times is, although that's high, and I guess it's subject to risk to the growth rate that they're able to produce going forward, that's not that high compared to some other well-known names, like Amazon or Ecolab, that are also trading at those kinds of multiples. We think that the report was a good report. It beat expectations. It just didn't beat expectations by as much as folks had expected. The underlying fundamentals and Blackwell, which is what really has to work going forward, we're given the indication that that's going to come through. Right. And we got a couple of reports today from Marvell and from Dell that corroborated that, at least, as you said, in the rearview mirror, AI is still driving a lot of revenues and earnings for these companies.